Cool. Perfect. So, hey, welcome, guys. So this is our live Q&A. I'll start with Stuart. He had some questions that he posted in the live Q&A. And going forward, there's an event that I'll create every Thursday or whatever after this live Q&A. And so as you're going through the modules, that can be just kind of a little hub or a little notepad that you can use so that you're not forgetting questions and stuff like that. And also, maybe someone else is already asking a question that you're thinking of, so you don't need to. But let me see if I can't find the questions here. Oh, and then I'll need to pull up Tastyworks and I'll share my screen with you guys. So part of the Market Club training that I have available is I use it as a third-party software to be able to go long in positions. And in a position today, I was able to, in 7 days, get into American Express, essentially, AXP. And within 7 days, got a 200, I think it was 80% return on investment. Basically, wow. Yeah, tripled my money in 7 days. And so I'm like, that's cool. That's cool. I like that. And so that was a big win for me. So let's see. Stuart, you're asking, what does it mean to take in a credit when you sell to open or go short? I was lost at the beginning of the credit spread example in Module 3. So let me share my screen with you so that you can see. Let's see, share. There we go. Here we go. Okay, cool. Can y'all see that? That's my Tastyworks screen?
Yep.
Cool. So you asked, what does it mean to take in a credit whenever you go short? So let's use SPY. That's just the ETF for the S&P 500. And so you're asking, what does it mean to take in a credit? So you can take in a credit on the call side or the put side. But before I explain what it means to take in a credit, you first need to know and understand the concept of in-the-money strikes. So this middle column represents the strike prices. You can think of the contract agreement price. Like if you're in real estate, someone's selling a house for $250, the contract agreement price would be $250. So the strikes are the contract agreement price, and you need to first know the difference between in the money. You see that little ITM right there? Mm-hmm. In the money for every option is going to be the most expensive. So the furthest in the money strike is going to be the most expensive. The at the money is what is the price of the underlying security, in this case SPY. What is it trading at? It's at 268.89, and the at the money strike is the closest strike price to the price of the underlying stock. Then for the call side, as you get higher, that becomes out the money. So 277 in this example on the call side is out the money for the call side. So you need to understand in the money, at the money, and out of the money to take in a credit. And this is what you need to know. For a call side, whenever a strike is in the money, I'll explain the put here in a second, but for the call side.
And that's a call is when you are buying a contract to a right to purchase a stock at a particular price. Is that
correct? Yes. Okay. So in the money, a 260 in this example gives you the right to purchase SPY at $260 per share. And since one contract controls 100, that'd be 2,600.
Yep.
Now that's a big discount compared to that it's trading at
it's almost $9 less.
Right. So for the call side, in the money is whenever the strike price is lower. That gives you the right to buy the underlying stock for a cheaper price. You can think coupon here.
Yeah.
At the money, it's at the money. And then obviously you're not going to pay $277 whenever you can just buy it on the market for $269, we'll call it, on the call side.
Why would anybody ever place a call out of the money?
Yes, they will. And I'll explain that to you here in a second once I get to the credit portion. But let me go to the put side. So the puts, can you tell me, Stuart, what the puts do?
The puts are a right to sell the stock at a particular price within a time frame.
Correct. Yes. So puts in the money, let's say 277. The 277 gives you the right to sell SPY at $277 whenever it's only trading at 269. So you can think of this as like a voucher. It gives you, you can turn it in to get something of value here. So in the money for the puts is the higher price strikes. At the money is the one closest, and the lower price you're not going to sell. You're not a 260 put. You're not going to sell it at 260 when you could just turn around and sell it on the open market at 269. So you need to understand that. So to break it down, either on the call or the put side, to take in a credit when you sell to open or go short that means that you've sold something. So you've borrowed. Someone that has, a retailer that sells phones in their little shop. They're John Smith, and you just know that they sell phones in their little shop. You meet your friend that's coming back from Africa, and they have not had access to an iPhone for 3 years. They really, 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 really want the latest, newest iPhone. So you go to John Smith that sells iPhones. You say, hey, John Smith, let me borrow that iPhone at market value. Put me on the hook for it. He gives it to you, says, okay. You go and sell it to your friend that came from Africa, and you sell it for twice as much. You take in the capital, and you repay John Smith for the iPhone that you borrowed.
At the market value.
Yeah, you repay him at the market value. That was your agreement with him. And then you keep the difference.
Okay.
So in the same way we can do that with options, we can sell to open, which means we don't ever own it, but we essentially borrow it and sell it to someone else that has a greater demand for it.
Okay.
So when we do that, if we sell to open, remember in the money, either at the money and all the way to in the money, as it becomes in the money, it becomes more expensive. So as you go from out of the money to all the way to at the money to in the money, it just becomes more and more expensive. So whenever we sell to open something, we're taking in that credit. Does that make sense?
Taking it in, you mean, so when I see like so at let's say in the money a contract at 266, right?
Right.
If I were the bid is $5.94, right?
Yep.
Is that the price of the contract?
Yes. So you ask that question up here. You say, how do you make money on a trade when you bid higher but sell lower? So I'll answer that question since you just asked it, and then I'll go to your third question. So as I mentioned in the module, that as retail traders, we always buy at the higher price, which is
the ask price.
And we always sell at the lower price.
Yeah.
So the
bid and the ask, that's $5.94 a share.
It's $5.94. Remember, contracts are like your earnest
money. For the contract. $5 for one share of the contract. So would that be multiplied by 100?
Yes. So you're on the line. If you're selling it, you're obligated to provide it. You borrowed something, you're obligated to repay it. 100 shares.
And so would that $5.94, would that become $594?
So remember in the example about real estate and the earnest money?
Yeah.
So the price or the premium of the contract, remember the contract just gives you the right to control the shares at the agreed upon price. So this is like your earnest money.
Yeah.
So this isn't reflective of how much you're on the hook for of the underlying stock, anything like that. All this is doing.
Okay, so it's only $5.94, or I guess $6.02 for the contract.
Right. That's what you're putting down. That's kind of your down payment, your earnest money to have the control.
100 shares.
Yeah, to be able to control that for the amount of time. So there's always times and strike prices in every option contract.
Gotcha. I wasn't sure if you multiplied the 602 by 100 or something like that.
No, what you multiply is the strike price.
The strike price by 100.
You're obligated. Let's say you sell to open. So you click on that bid, you sell at the lower price because you always sell at the lower price and buy
at the higher price. Yep.
So if you're selling to open, you're selling at the bid, the lower price. you're
Okay.
obligated to provide 100 shares of SPY at $266 per share. So that's $2,660 that you're obligated to provide.
Okay.
Does that make sense?
Because when you sell to open, you're obligated. Yeah, if you go short, you're obligated.
Mhm.
If you
Long.
buy to open, you have a right but not an obligation.
Correct. Yes. So, John, I see your face. What's your question?
How much did you say you're on the hook for?
So you're on the hook for the strike price
Times 100?
times 100.
So 26,000.
2,600. 2,660. Right?
Add two zeros to the end of that.
Yeah,
and
Oh yeah, it's
26,000.
26,000. Yes. It's 26,000.
I just wanted to make sure.
Yeah.
I have a calculator. I'm not a math genius.
In a margin account, it's half. It's really half that you're
Okay.
actually being held from your actual capital, because your margin account takes half of that into account.
And that's some tricky stuff, getting into margin requirements and things like that. I'm going to teach you guys where you get into a trade where you're never naked, which means that you just sold to open. Because I'm not going to teach you that. You can learn it, and there's benefits to it, but there's also greater risks. And as you're getting started, I'd say for the first 6 to 12 months, don't even sell to open. You always need to hedge.
Buy to open.
Yeah, so let me talk a little bit about that.
Okay.
So I'm going to teach you guys in this module, and I encourage you, at least for your 6 to 12 months, as you're learning the ropes, to never go what's called naked, but to always hedge yourself with a long position. And whenever you do that, you create a credit spread. So Stuart, your third question was, what does it mean to hedge your short position with a long position?
Yes.
So a credit spread is called a credit spread because you get paid the difference between the strikes. The goal is that you borrow and sell something at a higher price, and you go long or have the right to buy something at a lower price.
So are you playing a call and a put against each other?
You can, but idealistically, you're pairing it up. If you're going short in a call, you're also hedging yourself with a long call. Now,
Okay.
Can you also go short in a put with a long put, and you create a strategy that I'll get into? You can do that, but to go short, you're selling something of higher value, which is this 269. It's closer to the money, so it's higher value, and then you're hedging yourself by giving you the right to buy this at 270 with this lower value. And it takes in the difference between these two, the bid of what you sold to open and the ask of what you bought to open. And that's what creates the credit, is the difference that you sold something of higher value, you borrowed and sold it, but then you hedged yourself and you bought something of a little bit less value just so that you can define your loss.
I thought a sell to open was a call, and a buy to open was a put. Is that
So
that's not true?
you can do on both calls and put sides.
Yeah.
You can sell to open, you can buy to open, you can sell to close, you can buy to close.
Okay.
On both
So
calls
those
and put sides.
Those patterns of contracts, they don't have anything to do with call or put. What explain to me again then, what's a call and what's a put?
Right. So a call, if you're long, so I told you can buy to open, sell to open, buy to close, and sell to close. That also means, so that's some terminology, and in the lingo cheat sheet, you can check that out. Also, there's what's called long and short. So breaking down that, because I'll tell you the difference between calls and puts, but I first got to build the foundation into that. Whenever you go short, you're borrowing something that you never owned.
You don't have,
and selling it to someone else. And the goal is that you sell it to someone else more than you're on the hook.
Yes.
To borrow it. You keep that difference. That's called going short. Going long is that you say, hey, I like this. I think that it's going to go in this direction, and I want, in 30 days from now, I want the right to control this stock, but I don't necessarily want to be obligated to do it. So what does that look like? So on the call side, remember in the money is these, the cheaper price. I want the right to buy this contract, 100 shares at
Stop bugging me.
at 264. But if I don't want to exercise it, if for some odd reason I don't like SPY, whatever, I just want to walk away, sure, I have that. I'm not obligated to buy it at the 264.
And you would just lose your earnest money.
I would lose this. Now you're not going to do that, but that's just for example's sake. You have the right to buy it at 264, but you're not obligated. At the end of the day, you could say, no, I don't want to, what's called exercise my option. I don't want to take you up at that contract price, and I'll just lose this earnest money.
Forfeit the $7 or whatever.
Yes. So you need to, so a call, coming back to it, a call is like a coupon. It gives you the right, like you take a coupon, $1 off a gallon of milk, you know, you take that in. Let's say you paid 50 cents to have a coupon that's $1 off milk.
Yep.
Would that be worth it to you?
Totally. You save 50 cents.
Yeah, you save 50 cents. It's nothing huge, but you're still saving 50 cents. Someone says, hey, you got this coupon $1 off. I'll sell it to you for 50 cents. You're like, cool. I like that. Yeah, I'll take that. I need milk. And so a call is like a coupon. It gives you the right to buy the underlying security at a cheaper or less price if it's at the money or in the money.
That's if you're buying the call.
That's if you're buying, yeah. And then I'll break down what it is to go short. So I'm good. So that's if you're buying. Now if you're
and buying a call, you said it only happens at the money or in the money?
No. Right. Because you're not going to want to say, let's say you're controlling, let me just clear this. Let's say you're controlling this 270 strike. You're not going to buy SPY at $270 whenever it's trading at $269 on the market.
Sure.
So this is worthless. Even if you paid 50 cents for this coupon, for this contract, you're still not going to do it because you can still just go to the market and get milk that much more cheaper.
It'd be like buying a coupon to pay more at the store.
Right. It just doesn't make sense. Yeah. Even if you paid 50 cents, you're like, it still doesn't make sense. Let me just throw away that. I lost that 50 cents. Yep. Okay. Too bad. Maybe next time.
Okay. That makes sense.
That's the call side going long. The put side going long gives you the right to sell the underlying security at the agreed upon price. So in the money is anything that at the current stock price or lower, which means, let's say this 276, this is like a voucher that I have the right to sell SPY at $276 per share, even whenever it's only trading at 269. Does that make sense?
What I'm trying to figure out is how do you, so you buy this coupon for the right to sell SPY at 276 when its current market value is 268.
Uh-huh.
And that contract costs you $7.98. Why can't you just then turn around and then like exercise that contract and make all that money right away?
Yeah.
You have to find somebody to buy it, or I don't.
That's a good question. So you paid this much for it.
Yeah.
So for you to break even on this, you need the stock to raise $7.98 above 276.
Okay. So
I don't get that either.
So the at the money price, like the stock, the market has to move in such a way where the stock price would go up essentially to $284 then.
Sure.
That would be a break even.
Yes. The reason why is because you paid this much to control, or you paid this much, 278, to control the 276 strike option. So you're already invested that much into it. So for you to break, and remember, this is times 100. So
That's what I was wondering that
so that's not $7.98, like $7.98.
Yes.
It's $7, and I don't know why. Don't ask me who invented
Okay.
that. Why don't they just do everything by multiplies? I don't know.
Yeah.
But it's the way that the system is. So,
Okay.
but you paid that much for that voucher. So think about this. We had, and you did too. We had 10 cars that we owned for our Turo rental business, car rental business, right? And whenever we decided to transition out of the car rental business, we needed to sell our cars. And we had 3 cars towards the end of these 3 months that we couldn't get sold. So what did we do? We took those cars to CarMax and we said, hey, I want to sell you this car. They analyzed it and they said, hey, perfect. Here's my offer. And they gave me a piece of paper and they said, we'll give you, X amount of money and you can cash us in for this car. Let's say a week goes by and something happens. I could take that car into there, theoretically speaking, and get that much money because they gave me an agreement, a voucher that they would give me this much money for this this car. In the same way, puts are like that. It's like if you take a car, like let's say your own SPY, and you say, let's take my SPY car stock to CarMax. I want someone to guarantee me that I can sell it at, in this example, $276, if worst case scenario. If you're long, you have the right to cash in that voucher, to go back to CarMax and say, hey, buy my car at $276, even if it's only trading at $268. So puts are like a voucher that you have the right to execute this option at this price, even if it's above the price of the underlying security. When you're going long.
Help me with that. I'm looking at the lingo sheet.
Yeah.
Long says when you actually buy a stock or option.
Yeah. So
The position you're in is called long.
Yeah, buying to open, yes.
What's the difference between buying and borrowing?
Buying
For short.
Yeah, so buying is going long and borrowing is going short. They're the same.
Well, I understand the English,
Yeah,
but what is happening in the market? What am I actually doing?
right.
What
So,
distinguish between the two if I'm looking at this page that you have shared with us?
yeah, the either lingo cheat sheet or the option contracts here, the option chain. Whenever you are buying, it gives you the right, but not the obligation, to execute that contract at the agreed upon price. So for calls, that gives you in the money calls at the example of 263. If you had this, if you were long, if you bought to open this 263 call, this gives you the right to execute and to buy 100 shares per contract of SPY at 263, even though it's trading at 269. So again, whenever you're going long or buying to open, same thing. In a call, an in the money option is whenever the strike price is lower than the underlying security, and it's the coupon. It gives you the right, but not the obligation. The big thing that you need to know there is that it gives you the choice. It gives you the choice. You can say, yes, I want to buy SPY at a discount, or you could say, hey, I've got this coupon here, but look, I still want to pay full price. You could do that. People don't do that, but you have that choice. So the big thing you need to know whenever you go long or you're buying to open is that it gives you the choice, but not the obligation. And on the call, it gives you the choice to buy the stock at a lower price if it's in the money. And on the put, it gives you the voucher to sell the stock at a higher price if it's in the money than the underlying stock. Now going short, you are obligated.
Okay, so let me stop you there for a second. If you're at 264 strike price, 263 strike price, whatever,
On the call side?
on the call side,
Yep.
and you go long, you buy this at $8.33. So $833 you're paying for the option to buy at 263.
Right.
So effectively, if I'm understanding what you're saying, I need in real dollar terms, that stock price for it to be of real value would have to end up at 271.33.
Right. At expiration.
So I'm paying expecting that it's gonna go higher than that.
Yes. So if you're long in this, you want the choice to control SPY at 263, but you paid 833. You're absolutely right. You need to go all the way at expiration. You need to go all the way up to 271.33, and then any penny over that, you're in the gold. You're past your break-even point. You're making money there.
Okay.
Does that make sense, Stuart?
At 29 days.
Yeah, at 29 days.
It
Now,
expires, right?
and not all the time. So just to keep it simple, we'll just talk about like as at expiration. There are different factors, but that will impact it. But just to keep it simple, we'll say just at expiration, you need it to go all the way up your strike price plus the amount that you paid. But let's say this. So let's say a $2 difference. Look at this price. It's $2 in the money, right? It's trading at, we'll say 269. It's trading at 269 up here. This right here, 267 is at what we would buy to go long, buy to open was 531. But let's say a week ago, this stock was at, what would that be? $2 less. It would be at 267. So let's say a week ago, it was $2 less. So whenever we bought this, it was actually $2 out of the money. And then as the stock price moved up,
You made money.
our contract went into the money and became of more value. Do you follow me there? So let's say, for example, a week ago, we'll just call this, I know it says 270, but let's call it the 267 right here. Okay. A week ago, this one right here, just in your mind, say that's 267. We paid $344 for it, and we bought to open, we went long, and we expected SPY to move up in value, in price. We paid $344 for it, and then by today, that contract is now the 267. Using our imagination here, it's now increased in value by this much. So 344, 531 minus 344. So you've made that much profit in a week.
And that's just by selling the contract.
So it's buying to open. We're talking about going long, buying to open here. And then to capture that profit, we'd have to sell to close it.
So in real terms, I could care less what the stock price is. I'm just looking at movement and what it costs to buy and or I gain to sell.
John, you are on the money, my friend. Yes, and that is advanced like option strategies where it's called mechanically trading. And I know that you and I have talked about this, but it's just purely looking at the numbers. You shouldn't even need to be able to look at the charts and what your expectations. You should just be able to look at numbers of things and say, hey, this is what's going to happen. But that's three.
If that were the case, everybody would win.
Yeah. People do win. Like when the things that I'm teaching you, what's called high probability trading, directionally neutral, people win all the time because it's high probability and it's directionally neutral. It's directionally independent. So if you can take out the guess game of is this thing going to go up or down, and then you get into a trade that has a high probability, which I'll break that down for you in future module using the delta, then yes, you win money. And so it's about trading small, trading often, and just having that specialized knowledge, beginning to understand the concepts, and then you take action and execute on it.
In order to purchase a contract for the right to buy 100 shares of this stock, let's say at the money 268, wouldn't you need funding in your account of $26,000?
No.
Yeah, Jesse, you take that one.
No, sorry. No, you don't need any. You only need the 468. You should have 2,000 just because that's the margin minimum requirement to have that in your account. But assuming that's the case, then you only need what's
The
going
money
to
for the contract.
that it'll deduct 465 out of your option buying power, which is up at the top of Tastyworks.
Okay.
Yeah, so you're on the hook for that that premium that
The
you've
price
paid.
of the contract.
Yeah, that you bought for the coupon. You paid 50
What-
cents for a dollar coupon.
What about if you went short?
Yeah, so if you go short,
then you need to have funding in your account, right?
you do, and that's why I teach. You need to have $2,000 to have a margin account, which allows you to go short. And margin requirements are, it's a complex calculation.
Yeah.
I just let the platform do it for me. Like for instance, watch, I'll just do this right quick. So let's say I wanted to go short. I don't encourage you guys to go short for the next 6 to 12 months. But look, it will say how much I need.
Okay, you need $5,000 in your account to buy that contract.
Yeah, of buying power. So my account has more than this, but it's already invested in other things.
Sure.
And so so it'll calculate it for you.
Okay, I see it.
But again, let's say we do go short. I always encourage you to go long by hedging yourself.
Yeah.
So if we sell the 269, we're obligated to provide 100 shares at $269 per share.
Yeah.
But if we buy to open, so we sold to open the 269, if we buy to open, we now have the right to buy 100 shares at 270. So the max loss here is $1 times 100. But we're taking in a 56-cent credit, or $56, right?
Yes. Mm-hmm.
So our max loss here is $44 because that's the difference between the strikes minus the credit. So we're on the hook for this, but we hedged ourselves by saying, hey, so I'm obligated with the short position, but I'm going to hedge myself by giving myself back the right at this further out the money, less in value. And to do so, I sold this higher, closer to the money contract. It costs more, so I sold it. And then I bought this lower, further out the money, just barely, but further out the money. And that difference there credits my account with 56 cents times 100 is $56. And so my max loss, and it shows you over here, max profit is 56, and max loss is here.
Gotcha. Max profit for the 100 shares?
Yeah, so I'm on the hook for 100 shares.
Yeah.
And in this particular trade, this is called a bear call spread, and we'll get into this, but just kind of wetting your whistle. My max profit is the credit I received to open this contract. So
and that's 56 cents per share.
56 cents per share is my max profit. It's the credit I took in per share times 100 per contract. Now, if I went up and I did 2 contracts, then now my max profit doubles.
Yeah.
So
what's your max loss?
When you do this, what is your where's the getting out point?
Yes. So I'll teach you guys, and this is how I trade, is to aim to capture 50% of the credit you receive.
Okay.
So if you take in 56 cents or $56, and your max loss is here, you want to try to capture, $28 of this. And
you're getting better at that math.
Yeah, thank you. Woo, simple numbers. You don't know, but I typed it in. You want to try to capture 50% of that. The reason why is pigs get fat, hogs get slaughtered. If you can get in and get out of a trade by naturally what's called managing your profits or managing your exits, your probability increases.
Yeah.
Because let's say this trade, if it goes all the way to expiration, we're in a 30-day period here. It's 29 days. We'll call it 30 days. It's 30 days till expiration. For me to capture my max profit, this thing has to go all the way to expiration. But what if I could capture 50% of this, so $28, in only 10 days? So now
Why does it have to go all the way to expiration?
Why?
Wouldn't it depend on stock price?
For me to get the max profit, this thing has to go all the way to expiration.
Okay, that I don't understand.
It's because it's the basis of its expiration. So it's that coupon right down here. Like you want, whenever we're doing credit spreads, we want what's our strike prices, which is this 269, 270. Whatever credit spread we put on, either on the call side or the put side, we want at expiration these contracts to be out of the money. The reason why we want them to be out of the money, so we want SPY in 30 days to be anywhere lower than 269. The reason why is because whenever these contracts are out of the money, they become worthless. So if we sold it at 56 cents, now whenever we close it, we buy to close it, and we buy it at 1 penny. It's worthless now. So we get to capture all of the profit.
You're basically selling what the basis of it is. You're selling the option premium, and option premium decays over time, and in 29 days all that premium that you've collected by selling it, you get to keep as profit, because you're not selling it back to close it. You're just keeping it because it expires worthless.
It's kind of like this. You ready? I got another illustration for you. You take a 2-pound pack of meat from the grocery store. You take it and you borrow it, and you sell it to Stan, your friend Stan, that wants 2 pounds of ground beef. You're on the hook not to provide fresh or rotten ground beef. You're on the hook to provide 2 pounds of ground beef. So you sold it to Stan at $5, and then you went to the market and you said, in 30 days, I will give, grocery store, I'll give you back 2 pounds of ground beef. So you went to their competitors at the 30-day, and you went in and you got their manager special. 2 pounds of ground beef, and it's a manager special because it's about to expire. So whereas you sold it to Stan for $5, you now bought close to expiration ground beef that maybe is only $1 because it's close to expiration. And as it gets closer to expiration, it loses value. So you say, perfect, I'll take that. Here's $1. Give me my 2 pounds of ground beef. I'm not on the hook to provide fresh or rotten ground beef. I'm on the hook to provide 2 pounds of ground beef. You go back to the place that you borrowed it from, say, here's your 2 pounds of ground beef. You sold it to Stan for $5. You bought it manager special at a different store for $1 and gave it back that you're on the hook for of those 2 pounds of ground beef, and you kept the $4 difference.
I understand your example.
Yep.
But what I'm hearing you say is the goal at what you're doing here, or what we're going to be doing here, is to pick a
contract on strike price.
A contract that we expect to move quickly enough that we can recoup 50% of what our expected max profit is in the shortest amount of time.
Right.
That way we can get out and move on to the next one.
Yeah, and there's going to be there's 3 things that impact an option premium, its value. There's 3 things that impact it. And I'll break these things down for you guys. The number one thing that impacts an option's value is what? It's implied volatility. And in the stock market world, you can think of that as supply and demand. As the supply is low, the demand is high, that premium increases. It's the same reason why you're able to sell goods at 3 times their value during Christmas whenever the supply is low. So that's number one, is implied volatility is the number one impact of options premium or its value. Number 2 is price movement. So price movement of the underlying security. Is it moving for you for a call? If you're long or if you bought to open, you need the underlying security to move up. For a put, if you bought to open, you need the underlying security to move down. So price movement is that second piece. Is your contract going into the money or is it coming out of the money? The third thing, and that we'll take advantage of often, is what's called theta. It's option Greek. I didn't make it up. but it stands for time decay. And it's that illustration of beef. It's that as it gets closer to that expiration, it becomes less in value. And options, by default, their last 30 days, you can buy options a year, sometimes 2 years out, 18, 24 months out. We'll aim for the 45 to 60-day range whenever we're doing credit spreads. But the last 30 days, that's whenever that time decay, that manager special kind of scenario comes into play the most, and that option's premium decays. So the goal whenever we're going to do credit spreads, and this, in my opinion, is the only way to effectively, consistently turn a profit in trading, is that we're going to take advantage of all three of those things. The number one priority is going to be implied volatility, because you said, John, we want to find stocks that move quick enough in a short time that, you know, we can get out, capture 50% of the profit. We don't necessarily always need price movement. The biggest thing that fluctuates rapidly is implied volatility. So if that implied volatility pumps up really quick, goes up to 80, 90, 100% IV rank, the very next day, it could be at 90% IV rank. It could come all the way down to 50 IV rank, that implied volatility, that supply and demand ratio. And that movement alone can be a very quick move, and it's called an implied volatility crush, and it works in our favor. And I'll teach you that once we enter into a trade, that will automatically set up our order to where it's setting on the market with a good till cancel, and it will trigger out whenever that premium comes out, and we can buy back that manager special beef at a lower price and keep that premium. Does that make sense?
Yep.
I know there's a lot. So this will be recorded. This is a great content recording. So Stuart, you stirred the pot on this one. I'm loving it.
So could you repeat with the price movement?
Mm-hmm.
If we say it again, if we purchased a call in the money, then we want it to what?
So if we're buying to open or going long, those are both the same thing. Okay. A call option, we want the price of the underlying security, in this case SPY, to move up. The reason why is, again, if you look at my screen, remember how I had you use your imagination and said this was a 267 call that we bought here? And then a week later, the stock SPY moved by $2 or $3, whichever one that is.
Yeah.
And it came up here.
And we bought out of the money.
We bought out of the money. This is going long or buying to open.
Yep.
So we bought down here at 344. Then a few days later, it moves up a few dollars. And now we have the right to execute it at 267. And we keep the difference of this premium.
And you can execute the option anytime you want before its expiration. Absolutely.
Absolutely. Okay. And something to note, this has never happened in my books. Not in the past 4 years that I know of. So options are contracts. So again, the best way I know to think of a real estate in a house, and there's a seller, and let's say you're the buyer. They can essentially, the option, if you went, the option can be exercised at any point. So if you have this 267 call, but it still has 29 days to expiration, you can actually call up your broker and say, hey, I want to exercise this option, even though it has 29 days left. I want to exercise this option to buy 100 shares of SPY at 267, and whoever sold it to you is obligated to provide that. And they can do that at any point. If you buy, you have that right to exercise it, and if you sell, someone has the right that they could exercise early. But does that happen? It doesn't happen. Oftentimes, that's called exercising your option. If you're the one that's long, you have that right to exercise it. So you have the right to say to the person that sold it to you, give me my stuff. So you say, hey, give it to me. That I have that right. I can choose to do that or not to do that. If you sold it, someone else has that right, and you are on the hook to obligated that anytime someone can come knocking on your door, give me my stuff, and you have the obligation to provide it to them. That's called exercising your option if you're going long, and it's called being assigned if you're going short.
Okay.
And so that can happen. You can buy and sell at any time, even if it has 29 days left to expiration. You don't have to wait all the way till then.
Yeah.
If it moved up from, you bought it at 344 and it's up to 531, and that's part of your trade plan, which I strongly recommend, is always having a trade plan. You're like, hey, I'm okay with this much profit. Cool.
Yeah.
Boom. You close it.
Gotcha. And so you would decide to buy a call versus a put, okay, like option, like the reason why, if I were to decide I'm going to buy a call option, it's because I believe that it's a bear market and the strike price is going to go down.
If you're going long in a call, you want the price of the market or that security to go up.
So, okay, I'm a little bit confused. If we bought out of the money at 270,
yeah,
but then that was 267.
Right.
We were imagining 267.
267 here, yeah.
And then
it moves up here.
And then it moves up to what would that be up there?
It's well, I mean, if it would still be the 267 strike. It just moved into the money.
Oh, okay.
For the example, I can't go back in time, right? Like,
yeah.
But let's say we bought it here, 267. Okay. We paid this much for it, and then time went on, and this underlying security SPY went up by $3.
Okay.
You now have an option in the money, a coupon for the call sign to buy.
We were just imagining that 267 was initially out of the money at 344.
Mm-hmm.
And then over the course of some time, 267 became the market price.
Yeah,
was in the money.
Yeah, or even higher. So in a call, the higher it goes.
Yeah.
Let's say let's say we bought the 267. It was $5 out of the money, right?
Yeah.
You'd buy it at 199. Then SPY moves up by $1, $2, $3, $4, $5, $6. So if this, just imagine this is the 267.
Yeah.
You pay 199 to control the 267. SPY over the next 2 weeks moves up by $5. Now that option contract that you paid 199 for is now worth 531, and you could close this out.
And then you would make the difference on the premium of the contract.
Yeah. So what would that be? 330.
I think.
Yeah.
Yeah. I think I'm starting to understand this a little bit more. So the way that you would know, or the way that you would decide to buy that call option out of the money, would be through charting. It would be through charting that stock and looking for a pattern, and you recognizing like, okay, I think this strike price, I think it's going to go up by the patterns that I'm seeing through charting. And I think it's going to go up this amount of money within this period of time. And that's why you would buy the call option at where you would, right?
There's a few different options, a few different choices, should I say.
Yeah.
But yes, that's one of them. I'm going to teach you first to trade what's called mechanically.
Yeah.
Just looking at the numbers, we'll use Delta a lot, and we'll use IV rank. Those are the two things that I'll teach you how to trade off of. And we'll first trade mechanically from a numbers standpoint, and I'll teach you the 30 delta is really important, and the 15 delta is really important. I'm going to teach you first to trade from those aspects. Then secondarily, I'll teach you to trade from a charting standpoint of looking at this thing. And in the checklist, there's, is it above the 20-day moving average? Is it close to near? So there will be some technical pieces of it, but dominantly, or priority, should I say, will be mechanically, which will be using the numbers. And then secondarily, absolutely, there's a technical piece to it. And so your goal in your portfolio is to let's say you do put on a directional trade. So you're in SPY, you think it's going up, and you put on a directional trade that makes money if SPY goes up. Cool. You can absolutely do that. Just match it by putting on a trade in XYZ that makes money if the market goes down.
Putting on a trade in a different stock?
Yeah, you can do them in both in the same stock, but maybe let's say, let's look at this. Like, let's say back here, and it's just chugging up and away.
Yeah.
It wouldn't necessarily make sense to put on, what's called an iron condor where you squeeze it if it's trending really strong. But that doesn't mean you can't trade that directionally, where you trade this stock that's trending up, but you find a different ticker or an ETF that's trending down, and you just match it.
Okay.
And so the goal is that and that's the directionally neutral piece, is so that it's not that you're trading every stock directionally neutral, but it's that your overall portfolio and in a whole, SPY is going up. I have a trade that makes money if it goes up, but I also have a trade in XYZ that makes money if it goes down. And
so the trading directionally neutral simply means that you are buying contracts that you believe the movement's going up, but you're also buying contracts that you believe the movement's going down.
Yes, and in sometimes there will be opportunities where you can squeeze a security, and you can put on both a bear call or bull put spread and a bear call spread, and you can play it on the both. That's if it's channeling.
Okay.
So the goal is that your overall portfolio, it's not in any direction. There's going to be, you're going to have to find this out for yourself. This is what I teach, that you want your overall portfolio to be directionally neutral. That means that if you do have a trade that makes money if it goes up, that's cool. That's great. You're taking advantage of that. You're used mechanical and technical analysis, and you say, hey, let's put on this trade. But you just match it with another one, or maybe it's going sideways, and you say, hey, I can squeeze this thing, and you just keep your portfolio balanced, and you'll use the delta to do that, and we'll break down deltas and things like that.
When are we going to talk about delta? Is that be in module 4 or?
I think it is in module 4. Let me see if I can pull it up.
I'm really understanding right now that I need to learn more about implied volatility. I still don't fully grasp that.
Yeah. So again, it's just the supply and demand, and it's often driven up by, I'm pulling up module 4 to see. It's often driven up by, nope, not that one. Driven up by fear. If fear is in the markets, implied volatility comes up.
And so what would the percentage do then? Because it's given by a percentage, right? The implied volatility is, we see it through a percentage sign. Is that right?
Yeah, so implied the IV rank, is what you're going to use dominantly, and that's in relation to itself. So take its lowest point and its highest point, and on a percentage, highest point, could be 20, the lowest point could be 1 of its implied volatility. The IV rank is, where does it fall on a scale of 1 to 100 in that? 20 is 100 and 1 is 1. And so if it's at 19, that's going to be like probably a 98% IV rank. Does that make sense?
I think I'm going to need to study this a lot more. I get the idea of supply and demand, but I don't know how that really translates to the numbers.
Sure. So IV rank is just the indicator.
Okay.
That says, oh, supply and demand is out of balance here. So it's out of balance by this percent.
Okay.
You can think of IV rank like that. Investopedia, I think I mentioned it. Investopedia is great as a resource.
Okay.
For basically any kind of, kind of questions that you have in that sense. So I've thrown a lot out at you guys.
This was really helpful. I feel like it took me to another step. So.
Oh, awesome. Well, I'm glad to hear that. So there is, we're going to be diving deeper into it. So, and you need to feel stretched. If you're not feeling stretched, and it's probably not, you're not doing, it's not going well. But also know this, something I told myself is, even if this thing took me 2 to 4 years, to learn how to do, would it be worth it?
Mhm.
And to double my money, get 100% return on investment every year. In my opinion, it was absolutely worth it. So something, especially as you're getting, you're getting kind of overwhelmed, just keep that long-term perspective in there, of, hey, this has some crazy potential. Like,
Yeah.
I think I shared with you guys that, and I was in a trade for 7 days, in AXP, and it made a 280% return on investment. 7 days.
Wow.
Yeah. And so it's like, there's potential, and I'll teach you guys how to have high probability trading directionally neutral, being able to capture these kind of trades, and just kind of crush through it,
Yeah. Sounds good.
But it is a journey. You're on a journey.
Mhm.
You need to feel, there is some challenge to it. That's okay. That's okay. You're learning a new concept in a new language. And so it's, so there's going to be part of that, but stick with it. You're in an immersion phase right now where you're just getting dunked, over and over. And before you know it, you won't feel like you're drowning anymore. You'll be start paddling and swimming.
Is there any way to do like paper trading with options, or is that just like paper trading is only for like long investments?
There is a way. It's Thinkorswim. Thinkorswim by TD Ameritrade. It's a broker platform. You don't have to put down any money to open the platform. It's an opening process just like it is Tastyworks. They ask you those 10 questions. You fill it out, submit, they approve, decline you. However, I don't speak about that much often. It's because Thinkorswim, its broker platform is like using DOS. It's just, it is very non-intuitive. And John, you might be like, hey, I can own that. He's the IT guy. But it's very, in my opinion, it's very non-intuitive. I've been on that platform for 4 years. And I still don't feel like I really know it all. That's the only platform that I know currently that does paper trading. For options trading. And I will say this, I use Thinkorswim to what's called backtest trades. So what you can do in Thinkorswim is you can say today's April 18th, 19th. You could say on April 2nd, I wanted to put on this trade in SPY at the 267 call strike price, and I know it'll pull up how much it costs, what's the implied volatility. You can say I want to buy to open 3 contracts, and then you can click a few days and see what happens with the real market. Okay, went all the way to the 6th. Okay, went all the way to the 12th. Okay, cool. And you can see what can happen, and that's called backtesting. And it also allows paper trading, but again, it's not very.
The platform is terrible.
I know that Tastyworks is coming out. They said in 2018 with paper trading.
Okay.
And I can't wait because, in my opinion, it's a great resource for brokers to have. Really, brokers need me to be successful at trading so that we put on more trades, because they get paid off commissions. They don't get paid if we make money or lose money. They get paid every trade that we put on. So if there's a resource that they can provide that makes us want to trade more, like paper trading, then it's beneficial. But right now, TD Ameritrade, Thinkorswim.
Gotcha. Thank you.
Yeah. John, do you have any closing questions? Oh, I think you're mute, maybe. There we go. You kind of hear you? Maybe.
Now you can hear me.
Ah, I see.
Yes, mute works.
Good.
Unfortunately, I haven't watched the entire video for session 3 yet.
Okay.
So I don't have all the information that Stuart did.
Yeah.
But it was definitely helpful to watch. I'm almost to the point where my Tastyworks account is funded.
Yeah.
So I've been looking around in there a little bit to try to figure some of this stuff out.
Cool.
And in the meantime, I'm just watching my stocks.
Oh, cool. Yeah, absolutely. Yeah, stock. What will be fun for you, John, as you begin to learn to understand options, is you can take, let's say you invest $5,000 into Ford, something like that, and you're like, hey, man, I really love Ford and I think it's going to go up. You could take that same $5,000 and invest in options, and you can control 10 times as much. 15 times as much. So you're able to leverage your capital in a lot greater capacity if you're already, trading stocks and already having some success there. But again, it comes, that comes down to what you being able to essentially guess the guessing game, right? Being able to direction. Whereas with options, you're not going to see that huge premium boost right out the gates, but you're going to be able to trade small and consistently. You're definitely going to be able to produce cash flow. My average monthly return on investment is around 10 to 15% every month. And I can do that in any type of market, and you can too. And so it'll be fun. I'm excited for you.
Yeah, I'm looking forward to seeing how that works. And I mean, we talk about these concepts right now, and it's all this murky idea of what it's going to look like when it actually happened. I talked to Christy last night.
Yeah.
And she was giving me the high five about the first trade and her first win, and everything else is negative and all that stuff. But it'll be interesting to see how this plays out.
Yeah, absolutely. All right. Well, if that's it, I'll call this quits, and I really enjoyed the time. You gave me some good points to chat about, and that's always fun for me. So
thanks, Tim. Appreciate it.
Hey guys, can you do something for me?
Yeah.
Post inside of the exclusive Legacy Traders group and just say, hey man, the call was great. Check out the replay, something like that.
Sounds good.
Cool. All right guys, till next time.
All right, bye.